Green financing refers to the allocation of financial resources to projects and initiatives that have positive environmental impacts, promote sustainability, and address climate change. As the global community increasingly recognizes the urgent need to transition to a low-carbon economy, green financing has emerged as a crucial mechanism for funding initiatives that support environmental sustainability and social responsibility. This essay explores the implications of green financing on economic development, environmental protection, and social equity, highlighting its potential to drive transformative change in various sectors. At its core, green financing aims to mobilize capital for projects that contribute to environmental sustainability, such as renewable energy, energy efficiency, sustainable agriculture, and conservation efforts. By directing financial resources toward environmentally friendly initiatives, green financing can help mitigate the impacts of climate change, reduce greenhouse gas emissions, and promote the responsible use of natural resources. This shift towards sustainable investment is essential for achieving global climate goals, such as those outlined in the Paris Agreement. One of the primary benefits of green financing is its potential to stimulate economic development. Investments in green technologies and infrastructure can create jobs, drive innovation, and foster economic growth. For instance, the renewable energy sector has experienced significant growth in recent years, creating millions of jobs in areas such as solar and wind energy production, energy efficiency retrofitting, and sustainable transportation. By investing in green projects, governments and private investors can stimulate local economies, enhance energy security, and reduce dependence on fossil fuels. Moreover, green financing can enhance the resilience of communities and economies in the face of climate change. By funding projects that promote sustainable practices, such as flood defenses, sustainable agriculture, and water conservation, green financing can help communities adapt to the impacts of climate change. This proactive approach not only protects vulnerable populations but also reduces the long-term costs associated with climate-related disasters. By investing in resilience-building initiatives, governments and organizations can create safer and more sustainable communities. The transition to green financing also has significant implications for environmental protection. By prioritizing investments in projects with positive environmental outcomes, green financing can help conserve ecosystems, protect biodiversity, and promote sustainable land use practices. For example, funding for reforestation and habitat restoration projects can enhance carbon sequestration, improve air and water quality, and support wildlife conservation efforts. Additionally, green financing can incentivize businesses to adopt more sustainable practices, encouraging them to reduce waste, minimize their carbon footprint, and integrate sustainability into their operations. However, the implementation of green financing is not without challenges. One of the primary obstacles is the need for clear definitions and standards for what constitutes a green investment. The lack of standardized criteria can lead to confusion and skepticism among investors, as well as concerns about greenwashing, where companies falsely promote their products or practices as environmentally friendly. Establishing robust frameworks and certifications for green financing is essential to ensure transparency, accountability, and credibility in the market. Another challenge is the availability of financial resources for green projects, particularly in developing countries. While green financing has gained traction in developed nations, many developing countries still face significant barriers to accessing capital for sustainable initiatives. These barriers may include limited access to financial markets, high borrowing costs, and insufficient institutional capacity. To address these challenges, international cooperation and support are crucial. Initiatives such as climate finance mechanisms, public-private partnerships, and capacity-building programs can help mobilize resources for green projects in developing regions. Moreover, the integration of green financing into traditional financial systems requires a shift in mindset among investors and financial institutions. Many investors may prioritize short-term financial returns over long-term sustainability goals, leading to a reluctance to invest in green projects that may require longer payback periods. To overcome this challenge, it is essential to educate investors about the potential financial benefits of green financing, including the growing demand for sustainable products and services, the resilience of green investments in the face of regulatory changes, and the increasing awareness of environmental, social, and governance (ESG) factors in investment decisions. Social equity is another critical consideration in the context of green financing. While green projects can provide numerous benefits, it is essential to ensure that the benefits of green financing are distributed equitably across communities. Historically, marginalized populations may have been excluded from access to green financing opportunities, leading to disparities in the benefits derived from sustainable initiatives. To promote social equity, it is crucial to engage diverse stakeholders in the decision-making process and ensure that green financing initiatives address the needs of all community members, particularly those who are most vulnerable to the impacts of climate change. In conclusion, green financing presents a powerful opportunity to drive economic development, environmental protection, and social equity. By mobilizing financial resources for sustainable projects, green financing can create jobs, enhance community resilience, and promote responsible resource management. However, the successful implementation of green financing requires addressing challenges related to standardization, access to capital, investor mindset, and social equity. By fostering collaboration among governments, financial institutions, businesses, and communities, society can harness the potential of green financing to create a more sustainable and equitable future. As the global community confronts the urgent challenges of climate change and environmental degradation, prioritizing green financing will be essential for achieving long-term sustainability and fostering a healthier planet for generations to come.